The top 12 tax scams. Plus, how exactly does a portfolio manager make decisions about what companies to own? Those are our topics for this morning's program here on Dollars and Cents. Welcome to the program. We're Central Florida's longest running radio program, helping Central Floridians make sense out of all of those different decisions that have anything and everything to do with your dollars. As our good friend Bud Hedinger introduces us, we like to welcome you to the program as well. My name is Joel Garris. I am a certified financial planner and certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind. But before we get to the dirty dozen, if you will, tax scams that the IRS puts out, shockingly, they do that every year, and every year they have to keep updating it. We wanted to share with you a story that developed as a result of a client event that we were actually able to do. As many of you know, we host a series of quarterly events each year, and we also do additional events. And one of those additional events is a shred day. Well, obviously, we're not having a bunch of people in a ballroom for dinner anytime soon. Haven't had one of those since January because of all of this COVID stuff. We switched those to phone calls, and we still, though, wanted to at least have something, to be able to do something. And so we landed on our shred day, which we had done in the past. And so we said, okay, well, it's shred day. Everybody's stuck at home, and they're cleaning things out, and certainly they're going to have plenty of stuff that needs to get disposed of. And so we combine shredding documents with properly disposing of computer equipment, computer hardware, things like that. We have an IT guy in who kind of takes care of that part. And so we have the big shred truck. So that was the event that we said, okay, you know what, we're comfortable doing that because we'll just make it sort of a drive-by thing, right? You drive up, stay in your car, open up the trunk, we take the stuff out of the trunk, we take care of it all for you. So had great participation this year as we did in past years. And so what we did was we also kind of combined a grab-and-go lunch, right, to get at least something, if you will, that felt normal in terms of how we typically do things in terms of client events. So we had a grab-and-go lunch. Caterer was there to help with that, and so all went very smoothly. And so the story that we really want to delve into this morning is one of the folks that came didn't want to shred a particular document. They wanted to give it to me. I'm like, okay, I'm not sure why I'm getting this, your stuff that you're supposed to be shredding, but they gave it to me. And I'm so glad they did, because here's what it was. It was, and we've got a copy of it right here on the table. It was their account application, and their transaction. We're holding them up for the video for the folks on YouTube, but we're not showing names. Their account opening and their account transaction statement from June 12th of 1989. This account statement was their opening one, and it was when they just started to invest. They took $150. That's all they had. $150. They bought 19.841 shares, and this particular fund at that point was $7.56. So they bought almost 20 shares, $7.50. In 1989, the gentleman was 31, and his wife was 28, and they had, at that point, a 4-year-old daughter, just starting out. She was a school teacher, he was a computer guy. Matter of fact, a few years later, probably more years later than that, but he actually developed our first website when we were known as Nelson Investment Planning Services. So that was all they had. They were just starting out, but they stuck with it. And They put in what they could and they stayed consistent. By establishing that systematic investment of $150 that they did in June of 1989, they kept at it and they kept building that. And every time they would get an increase in income, they would correspondingly increase how much they were saving. So what's really neat about this whole story, from that beginning back in 1989 when they first joined our firm as clients, today, well, they're older, as is everybody. He's now 62 and she's 59, and they're looking to retire with an investment portfolio that is close to $3 million. Stop and think about that for just a second. Started with 150, young daughter, normal jobs, just putting in what they could. But doing it every month, being systematic on it, being intentional on it, and just a great story. The fund that they invested in, still investing in too, by the way, that was $7.56 a share, well, that's now $150 a share. That's the power of long-term investing. Things over time go up, because after all, their portfolio was one of stocks. So in fact, you can still own the same fund, and they still do, and they're still adding to it, except it's not $7.56 anymore. It's now like close to $150 a share. So because it's a large cap growth fund. And so we were standing there at the office and outside and sort of, reminiscing about all of that. And certainly a neat story as we work with them to transition to that next phase as they shift into retirement. But what's interesting about that, what's interesting and really kind of neat about seeing that power of time, that power of compounding, is there's really a slew of observations that we can make about this story and about this couple. And that's what makes it interesting, I think, is that they didn't start out with much, right? I mean, $150 a month, folks can generally find $150 a month. That's not, you don't need to start out with tens of thousands of dollars. $150 a month is what these people started out with. Fast forward since 1989 to 2020, and it's 31 years in their portfolio, $3 million. Obviously, they increased their contributions along the way, but there's an important concept. When you're young, you're not going to start out with $3 million. You're going to start out with what you have. And the reality is, you can start out with a small amount, like $150. So they didn't start out with much. That's number one. Second observation, they weren't the CEO. They weren't some inventor of the next best thing since sliced bread. Just normal jobs. She was a school teacher. He was an IT guy. Normal people, normal jobs. Nothing significant. Didn't inherit a bunch of money. Didn't win the lottery. Just normal people doing normal stuff. They stuck with it. They 1989, $150 a month. They stuck with it. Regular investing, putting money in on a regular basis, using the concept of systematically investing your money to help dollar cost average your investments. That ultimately helps to smooth out investment volatility on a regular basis. Most importantly, well, one of the more important parts of this conversation, they had time in, not timing. Think about that. They were age 28 and 31, started with $150 a month, now have an investment portfolio of $3 million. Think of all the events that happened since 1989, right? 1989, that's a lot. That's like 8 presidential elections, just to put it into a little perspective with what's going on today. The next observation, they regularly increase their savings. And this is the part that I think sometimes gets lost. They regularly increase their savings. As their pay went up, they increased how much they were saving. And then they owned a diversified portfolio of stocks. Yes, you do have to own stocks to achieve growth over time. That's what it comes down to. They owned a highly diversified portfolio of stocks. And then lastly, most importantly, this too can be you. This too can be you. Stop and think about that. This is an incredibly successful retirement in front of this couple. At a relatively early age, 62 and 59, to retire. So what are the ingredients? What are the ingredients for that successful retirement? It's not magic. It's not looking for some mysterious investment that's going to get you there overnight. It's consistency. It's starting early, saving often and regularly, staying consistent, and owning diversified portfolio stocks. There you have it. You want a successful retirement? You want a successful retirement at an early age? Get started. You don't need much to get started. This is a great, great story that we had an opportunity to share with you on the program this morning as a result of having that shred day and having them bring their original statement. $7.56 a share. Now it's $150. The power of time, the power of compounding. Just an incredible story that really underscores the keys to a successful retirement. We're going to take a break. We come back. We're doing the Dirty Dozen tax scams coming up next on Dollars and Cents. Dirty Dozen. Every year, the folks at the IRS publish the top 12 tax scams. And this year, just like any other year, there's another 12 to watch out for, particularly in light of COVID. So we're going to share with you those Dirty Dozen, or what the IRS refers to as those Dirty Dozen top 12 tax scams here on the program. Welcome, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on the News Radio Orlando network, along with 96.9 The Game. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web, with now 12,000 downloads of our program. That number keeps growing each and every week, and we certainly appreciate our podcast subscribers on any of the various podcast platforms out there, whether it's Spotify or iHeartRadio or Apple iTunes. You get the idea. We're pretty much on every platform. To find us, go to our website, nelsonfinancialplanning.com, and upper right-hand corner has all of the icons. You can click directly to go there, or just search your favorite social media platform with Nelson Financial Planning. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life. Just like that story we were telling in the prior segment. Change your life. Start out at $150 a month. Add 30 years, and you too can have a really great retirement at an early age. Those are some important concepts we shared, and really, I hope you took the time to really listen to that story we were talking about in the previous segment. Normal people doing normal things, starting out saving at an early age. Just incredible, incredible, incredible. One of the things, though, that you certainly want to make sure you avoid is these tax scams. So we're going to get into that and kind of go through those 12 real quick on the program, so at least you can kind of be thinking of them. We'll post the article, as we typically do, on our social media platforms. Anytime we talk about an article at length, we always like to post it so you can kind of refer back to it and look at the details on it. So we'll be putting it up this week on the various social media platforms. So here we go. So here are according to the IRS, the Dirty Dozen, the top 12 tax scams that you need to be aware of today, because some of them have a COVID economic stimulus type of spin to them as well. And I guess that's the first one. First one is the concept of playing on fear. So a lot of the phishing schemes that would typically be the same kind of phishing schemes that would be happening any time are really focusing on that fear of COVID. So a lot of the phishing schemes that tax scammers are doing reference the COVID-19 or coronavirus or your economic stimulus package. And what they do, of course, when they do that is they blast it out to a bunch of different people with the hope that, hey, if we get a few that respond back, that's all we need to stay afloat in terms of our criminal enterprise. The next one on the list is sort of that give until it hurts. And this really takes advantage of people's good nature, just like the other one. The first one on the list takes advantage of people's fear. This one takes advantage of their good nature. And a lot of scam artists will set up fake charities, particularly during times like this. And ultimately, those charities are completely fake. They're bogus websites. They may sound a little bit like a charity that you might be familiar with, but it's completely bogus. So to really be aware of that, understand that normally that type of a fraudulent scheme will start with unsolicited contact, right? I mean, contact that is initiated by them and not by you. So be aware there are just as many schemes out there that take advantage of your good nature. Number 3 is a familiar one, and it actually happened to my neighbor's parents, and that is this notion of a familiar voice. It's maybe it's a grandson or whatever might be, and they you can't quite hear them, and it's muffled, and it's very hard to understand. And they call and say, "Oh, I'm in jail in Mexico, and I need you to wire me money." And it's sort of that, that familiar voice kind of concept. Watch out for that. Here's the reality: the IRS is never going to call and demand payment, or threaten you, or ask for financial information over the phone. It doesn't happen. So if that happens, just hang up, just ignore it. Particularly that familiar voice, that scheme of oh, Grammy, I'm in a prison cell in Guadalajara, and you need to send money, and don't fall for that. Another way that they do it is and this is number 4 on the IRS's top 12 dirty dozen tax schemes, is using social media. Obviously, that's a new concept. As more folks, particularly older folks, get involved in social media, they may not be aware of some of the things that you don't want to post. And so fraudsters will certainly take care of that. And understand that if they have access to your social media, one of the basic element of any fraud, right, is convincing a potential victim that they're dealing with a trusted person that they can trust, that's close to them. And so that looking at your social media helps to sort of build that relationship or build that trust, so that when they talk to you, it really does seem like, oh, it must be legitimate. Number 5 on the dirty dozen list is this notion of your economic impact, your economic stimulus check. Obviously, those checks went out to a slew of Americans. A lot of people had to wait a long time, and so there were definitely some scams out there that had to do with, oh, we can get you your economic stimulus payment check faster, or it went to you improperly and you need to send it back. The reality is that even the IRS recently warned nursing homes and care facilities that those economic impact checks were property of the recipients, not of the caregiving facility. So be aware that those are certainly ones that can get people's mind. Perhaps one of the newer avenues for scammers is this notion of trying to target more seniors more and more, particularly in COVID times when seniors are being more isolated and feeling more alone and more at home. That makes you more susceptible to having somebody to at least talk to, and that's really kind of one of their modes, if you will. So those are the first 6 of the latest dirty dozen tax scams, courtesy of the IRS's annual publication of that list. We're going to slide to a break, and when we come back, we will pick up the other 6, so folks can be informed of things to look out for when it comes to keeping them safe and away from scam artists. Coming up next here on Dollars and Cents, this is Joel Garris, Nelson Financial Planning, News Radio WFLA and 96.9 The Game. The Dirty Dozen. Every year, the folks at the IRS put out the top 12 tax scams, affectionately referred to as the Dirty Dozen, and so we wanted to spend some time. They just announced those last month, and some of them have certainly changed since the last time they gave out their Dirty Dozen, mostly because of COVID and playing on people's fears and people's emotions and people's good nature and people's loneliness. And so last segment we covered sort of the first six. We're going to cover the next six here on the program. Welcome back, of course, to Dollars and Cents, Central Florida's longest running radio program, where we help you make sense out of all of those different decisions that have anything and everything to do with your dollars. Coming to you here on News Radio WFLA Orlando Network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web, an accolade that the folks at FeedSpot gave us at the beginning of the year. Now over 12,000 downloads of our podcast. So we're happy to have our podcast subscribers join us as well. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to get you started. Doesn't matter how old you are. If you listen to the story at the beginning of the program, start young. Start with as little as 150, and you too can have a successful retirement. That's, of course, what we do. We help people change their life with a successful financial plan that provides them with peace of mind for the future. So back to the back six. And again, we're going to post the article on our social media platforms so that you can also take a look at it as well. The point of sharing this with you, of course, is to keep you safe, right? I mean, you don't want to fall victim to any of these scams along the way. So here are the back six. Next, language barriers. Oftentimes, you'll get folks that are trying to impersonate IRS officials. They target people that have limited proficiency in English. They use that with threats of deportation, jail time, things like that. So they specifically target people that maybe English isn't their first language. That's sort of one of the areas where you'll see this tax scam. Next one is the notion of just fraudulent tax preparers. I mean, this year with the change of the date from April 15th to July 15th, there was an uptick in sort of tax preparers that bill themselves as tax preparers, that are doing returns, that are juicing up a refund and then splitting that with you, or taking a portion of your refund. But what they're doing there is they're just making stuff up on your tax return, or taking just incredibly ludicrous aggressive positions in terms of how they are reporting information on your tax return. So be particularly careful with that. If you go and use someone to prepare your taxes, make sure they are in fact signing the return. That's how you can kind of know, wait a minute, something may be up here, is if they're ghosting the return, meaning, oh, we did it and we got this big refund and we're going to take half of the refund, and then they don't sign the return. If they don't sign the return, then they don't have any liability. So make sure that your tax preparer, whoever that may be, actually signs the return. Next up, we're on number 9 now on this list of Dirty Dozen tax scams. This one is one that you hear a lot about. It's troubling, and it's all these companies out there that are advertising that we can help you get out of debt with the IRS. We're gonna help you get out of. You're gonna reduce your tax bill, and tomorrow will be a better day. And these tax debt resolution companies charge big fees, and very often don't get any level of results. Here's the statistic. So when you try and negotiate with the IRS, it's called an offer in compromise. So in fiscal year 2019, there were a total of 54,000 offers in compromise, meaning hey, IRS, will you take less than what I owe? I've got this money now, I can give it to you. Will you take less? More often than not, the IRS doesn't have to take less because they kind of have a lot of power over your future earnings and future paychecks. So they don't really have much of an incentive to agree to these offers in compromise. And if you look at the statistics, fiscal year 2019, there was 54,000 offers in compromise, and they took 18,000. So that is about a third if you do the math. So just be careful when you're using companies that advertise that, hey, we can get you out of debt with the IRS, that you're not just going to wind up paying really, really, really expensive high fees, and at the end of the day, not really have anything to show for it. Similarly is the notion of filing a straight up just bogus return that allows for a refund into your checking account that you wouldn't otherwise be able to have, and then someone calls you and says, oh, well, that refund that you got, that was deposited by mistake, and ultimately we're going to want that, we want that money back, and then you wind up having somebody take money out of your checking account. So be careful of that. And then the next one, number 11 on the list here, is the notion of employers also need to be aware. This isn't just tax scammers targeting individuals. Certainly they do, but don't forget they also target employers as well. So employers need to be careful of the information that they hold, because your employer is going to have your Social Security number. It's going to have all of those payroll files. And so there's certainly an attempt by scammers to try and get access to that information. So make sure your employer, or if you have your own business, make sure that you are using the proper level of security, or as high level security as you can have, in order to protect that information. And then of course, lastly, and this one is not just for tax scams, but generally for scams in general, is this notion of ransomware, right? Most of the time, ransomware, that stuff that pops up and locks up your computer and says you don't have access to your data anymore because you downloaded inadvertently some type of a virus, and unless you pay X number of dollars, typically in Bitcoin, because after all, that's the currency of crooks, you're never going to get access to your information anymore. And so that's the notion of ransomware and the kinds of things that can happen to you if you're not careful with technology. And it's all about trying to be as secure as possible. So those are your dirty dozen for the year 2020, updated courtesy of the IRS, all new for COVID times. They're seeing an uptick in scams, particularly taking advantage of people's loneliness, people's good nature, people's fear, and ultimately that's why we wanted to share that with you on the program this morning, to give you an understanding of the background of the kinds of things that typically happen, but how they have sort of morphed and what to be even more aware of during this time of the COVID pandemic. So we're going to take a break. When we come back from the break, we're going to talk about the thought process that goes into how a portfolio manager actually selects the companies that they invest in. So that should be kind of interesting. So stay tuned for that. Coming up next here on Dollars and Cents with me, Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando 96.9 The Game. So what's the thought process that goes into a portfolio manager when it comes to selecting the companies that they own? Obviously, that has to be a significant process of numbers and everything related to that. But on the program today, we wanted to share with you some of the particular things that portfolio managers look at. Welcome back, of course, to the program here on Dollars and Cents on News Radio Orlando and 96.9 The Game. Dollars and Cents, Central Florida's longest running radio program, helping you make sense out of all of those different decisions of life that have anything to do with your dollars. My name is Joel Garris of Nelson Financial Planning. I'm a certified financial planner, certified financial fiduciary, where our team at Nelson Financial Planning of certified financial fiduciary stands ready this very week to help you get started with a successful financial plan that provides you with peace of mind for the future. One of the top 25 financial planning podcasts on the World Wide Web with over 12,000 downloads. So hello to our podcast subscribers as well. So every quarter for decades now, we've had a variety of client investor education meetings. It's something that we believe very strongly in at Nelson Financial Planning, is that we want our clients to be as educated as they possibly can be with what they own and with what the makeup is of their investments. So one of the things that we do, or one of the ways in which we do it, is that we have a series of events once a quarter where we bring in portfolio managers or economists or tax experts or whatever the case may be, and we provide our clients an opportunity to hear directly from these folks to help better understand what it is and how they are investing. And so obviously during COVID, we've had to cancel those meetings, but we have switched them to be phone calls. So we're doing those kind of a little bit more often than quarterly, about every couple of months or so. Matter of fact, we got another one coming up on September 9th for our clients. And so of late, of course, is the topic of how COVID is impacting not just the markets, but the structural changes that it is making in the economy, I think, are just beginning to be understood. You hear the expression of the notion of the 2030. We're experiencing 2030 in 2020. And what that means is that there were certainly a lot of trends out there, whether it was digitization of information, was cloud computing, telemed, those kinds of things that were sort of out there and sort of, kind of growing, certainly at a pretty good pace. But what we're seeing now with COVID is a massive acceleration. So it's almost like what you would have expected to have seen in 2030 on the current track record that they were on, the current growth rate that they were on, we're seeing that pulled into this year. So that's the notion of we're seeing the year 2030 in the year 2020, because COVID has dramatically accelerated a lot of the technologically driven types of trends that were already out there. At the same point in time, it has also flipped those trends that were already seeing a decline, think retail, think broadcast television, those types of things that were already seeing a decline. It sort of accelerated that. So it's almost like, again, it took where you might have wound up in the year 2030 and brought it forward to the year 2020. So that's the decision landscape. So the answer, so as we're having these conversations with the portfolio managers, and we're now doing it over the phone, I think, courtesy of the commentary on the last one that we did back in July, we want to share with you on the program sort of three principles that drive the decision making of what a portfolio manager is doing. And so the first item is you have to understand what drives what. Okay, so we know stock prices. Well, that determines the value of my portfolio. Okay, so but what drives stock prices? Well, what drives stock prices of a particular company is whether the company's making money or not, earnings, right? And so then what ultimately drives earnings? Well, that's revenue, right? Because you bring in money, you have expenses, and what's left over is your earnings. Hopefully that's a positive number, making it earnings. Otherwise, it's a loss. So revenue becomes a chief focus on what the portfolio managers are looking at. What's the revenue growth? What's the potential revenue growth? That becomes almost a starting point, is you start by looking at above average revenue growth. So understanding what drives what all comes back to revenue. Number two, and I think this one is important, and people sort of don't appreciate this as much, but people in fact do matter. The organization structure, the management, the team in place is very important for the success of that company. If Apple didn't have Steve Jobs, I'm not sure Apple would have gotten to where it is today. the transition to Tim Cook. Again, I don't know that Apple would be where it is today without those people. So one of the things that the portfolio managers shared with us is that they look at when they invest in a company as part of a fund, that they almost think of it as that they're underwriting the management team that's in place. So they spend as much time getting to know the people that are at the helm of the business, as much time as getting to know those people as they do the financial statements, the businesses, and certainly this one, if you've ever had a business, you understand is very, very true. People really, truly matter, and they're a big driver. And just this Friday, I said to my team, we have had a very successful decade, and a lot of that is attributable to the team that we have placed and the consistency that brings. So people matter, particularly from an investment perspective. And then change, right? I mean, here we are. I mean, this is probably going to be the most significant change structurally in the economy during COVID that we will see in our lifetime. And change can create opportunity, and opportunity can create growth, or it can go the other way. So it's important to understand sort of what's going on in that backdrop and that change that ultimately can shift things structurally and what things might look like on the other side. Talked a little bit about that earlier, right? I mean, telemed, probably here to stay. Digitization of information, here to stay. Delivery of stuff, here to stay, because people realize it's a lot more convenient and it's a lot more effective. Shoot, I was in a grocery store yesterday. I almost got knocked over by the Amazon guy shopping for everybody. Those guys are in there and hustling, and all of the little tables that you would typically sit at to eat at in the grocery store had all been converted over to the delivery stuff for Amazon. So again, those trends are here to stay. Meanwhile, broadcast television, retail, that's a lot of change, and so change creates opportunity, and so it's important to look at. So those are the three things. So those are the three things. Got to look at the revenue, got to look at people, and got to look at what's going on with the landscape of which a business operates. So those are the really big things that portfolio managers look at in determining exactly what they need to do in terms of determining whether to invest in a company. There's one other tidbit that we also want to kind of add in the last minute of the program, and it's something that we look at particularly at Nelson Financial Planning, is we're looking for funds that also compensate portfolio managers over extended time frames. Why? Because if you're paid on your performance over a longer period of time, you have a tendency to produce much more consistent results. You're not swinging for the fences. You're not paid on 1 year, 3 year, 5 year. You're paid on a 7 or 8 year period of time. And that's the way that you can achieve much greater consistency of results, because you're not getting paid based upon a short period of time. So make sure you also check that out when it comes to investing. Interestingly, if you're paid on an 8 year basis, you got nothing to do with the election cycle, because that's 4 different federal election cycles in that period of time. So some things to think about. We'll wrap it on up and get on out of here. Thanks for listening to Dollars and Cents. This is Joel Garrison, Nelson Financial Planning, News Radio, WFLA, Orlando.